Today's gold bull market is still young, statistically, historically, and if you ask Wall Street, financially too. In the bull market of the 1970s, gold hit 209 new all-time highs. In the 2000s, we saw 106, but today, just 74. So if you're wondering whether the move is over, you're asking the wrong question. In late 2015, gold price bottomed around $1,055 an ounce. Since then, it's been grinding steadily higher. If this bull market repeats the move that we saw from 2002 to 2011, when gold rose from $250 an ounce to over $1,900, a greater than 7x gain, we could be looking at a price target of over $7,385. And that's not some pie-in-the-sky number, that's just the math. But you don't have to just take my word for it. JP Morgan recently projected that the gold price could cross $4,000 an ounce by the second quarter of 2026. So the question isn't if gold is in fact moving higher. The question is, what's fueling gold's bull market and who's getting in early? Let's start with the biggest buyers, central banks. Following the 2008 Great Financial Crisis, central banks began accumulating hard money assets. They've now been net buyers of gold for 15 years straight. And since 2022, they've been hoarding more than 1,000 tons of the yellow metal per year, the largest central bank gold purchases on record. This isn't just a hedge by central banks. This is a reallocation out of fiat currency and into real tangible assets. Meanwhile, the U.S. is running out of balance sheet. We are now paying over $1.1 trillion per year in interest payments alone. The national debt approaching $37 trillion and climbing fast. Top-level insiders like Treasury Secretary Scott Bessent acknowledge the current debt trajectory is completely unsustainable.
A tipping point in debt sustainability is very difficult to pinpoint, but what is not difficult to pinpoint is a trajectory, and the trajectory is unsustainable.
And when they acknowledge that we are facing an imminent debt crisis, you know that the clock is ticking. Just this Friday, Moody's downgraded the U.S. credit rating specifically due to rising government debt, stating, "We do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. Over the next decade, we expect larger deficits as entitlement spending rises while government revenue remains broadly flat." The exponential growth of U.S. and global debt levels is a fundamental factor underpinning the continued rise of gold's price and the growing loss of faith in paper money. To illustrate this trend, let's zoom out. China isn't just buying gold, they're dumping U.S. Treasuries. Since 2013, they have offloaded nearly $500 billion in U.S. debt, while ramping up gold reserves to historic highs. And it's not just the People's Bank of China stacking all that gold. In April, Chinese gold ETFs had their biggest monthly inflow ever in history. That is a sign that retail is finally stepping into the gold market too. When retail investors start waking up to gold's long-term trend, it's usually the start of the second leg of a bull market, not the end. But here's the thing. While central banks are buying physical gold, they aren't buying the companies pulling it out of the ground. The gold price is up more than 65% from its 2011 peak, but the GDXJ ETF, which tracks junior gold miners, is down over 65% from its peak. That is a major disconnect and a temporary one, because as gold prices remain elevated, margins for miners expand. And as investors look for leverage to gold, these overlooked companies start catching bids. Historically, they don't just follow the metal in a bull market, they outperform it by multiples. Technically, gold has already broken out of a 12-year consolidation pattern, a textbook cup and handle. And despite recent pullbacks, it remains firmly above its 200-day moving average. This isn't just some hype rally. This is a major macro trend, and it's only just beginning. So here's the bottom line. Gold's breakout is real. The big money is moving, and retail is just waking up. But the real opportunity might not be in the metal itself. It could be in the companies that still trade like gold is dead. That is why this is a prime time, in my opinion, to be looking at companies that own large known deposits of gold in prime jurisdictions. And that brings me to today's sponsor, Axcap Ventures, ticker symbol GARLF, whose insiders have been buying stock in recent weeks. Axcap Ventures was incorporated to make investments to rapidly capitalize on the distressed conditions of the gold mining industry. The management assumes that their assets, which are comprised of approximately 5.57 million ounces of gold equivalent resources in the measured and indicated category and an additional approximately 500,000 inferred, are valued around $5 an ounce, while peers are trading for 8 times as much or 700% more and could be re-rated. You heard that right. Now is the time to start researching Axcap Ventures, ticker GARLF. Their thesis is based on the case studies of previous instances in which similar situations have led to meaningful appreciation. Axcap Ventures' flagship Converse project in Nevada's Battle Mountain Trend, a premier gold jurisdiction producing 75% of U.S. gold, is a standout. The project's October 2024 mineral resource estimate reports 5.57 million ounces of measured and indicated gold and 0.42 million ounces inferred, with a drill program launched recently in March 2025. Insider purchases totaling $1.2 million in the first quarter of 2025 signal strong management confidence. For example, on May 1st, 2025, Mario Vetro, co-founder and director, purchased 20,000 shares. On top of that, Tyron Breitenbach, the second co-founder and a director, purchased 50,000. The day before that, on April 30th, Mario purchased 10,000. The day before that, 15,000 shares. On April 28th, he purchased 25,000. On April 25th, he purchased 110,000 shares. On the 24th, he purchased 60,000 shares at 15 cents Canadian. Collectively, a total of 240,000 shares just in the last week of April. The team assembled to run Axcap Ventures have been involved in the discovery of over 20 million ounces of gold in the course of previous endeavors. And here's the value proposition. Advanced gold deposits are trading anywhere from $40 to $60 per ounce. Axcap Ventures are trading at $5 per ounce. The company is cashed up with approximately $10 million, and peers trade at $49 an ounce on average, while Axcap Ventures' market cap translates to only $5 per ounce. So make sure to do your research on Axcap Ventures, ticker GARLF. The business model is simple. Drill the properties in order to create the conditions for an exit at valuations comparable to recent ones. I love the setup here, but as always, you've got to do your own due diligence on Axcap Ventures. The ticker is GARLF, and a great place to start is by visiting axcapventures.ca. There's a link down in the description, so check them out. Thanks for watching, everyone. Don't forget to like, comment, subscribe. Stay safe and happy stacking. Smart Silver Stacker,